Hello and welcome to Market Call tonight. I'm Mark Bunting. Thanks for being with us. As mentioned, David Burrows is here. He's taking questions on North American large caps. There are three ways to reach us. If you have a question for David, you can call us. It's toll free. You can use the email address, or if you prefer, how about Twitter? At Market Hall is the handle, is the address. Nice to see you.
Great to be here.
So I'm guessing this is the first time you've been on the show since the correction in October, right?
That's absolutely correct.
So most people were expecting something. It was fairly dramatic, and the snapback has been as well. What do you make of things now? Has anything changed for you that much?
No, our view has been really for 18 months that we are in a new secular bull market for stocks, that pullbacks are likely to continue to be more shallow and shorter lived than we have seen over the last many years. And that when you have a market that is getting both growing earnings and a slowly expanding multiple of earnings that investors are prepared to pay, it's a very durable market. And for consumer-led developed economies, very low inflation is a really great thing because the consumer has a little more money to spend and balance sheets are getting better. And there's some big sectors that are big winners from low energy prices and low inflation.
Such as?
Transportation, retail. The U.S. economy, 72% of the economic activity comes from the consumer. And in a world where inflation is low, that's a big win. So there's all kinds of sectors that can get revalued over a period of time if, in fact, commodity inflation remains low and labor inflation remains low, and we think that that's the case.
Are you paying more attention, David, to retailers now that energy costs are a lot lower than they were?
Yeah, all year long, we've been focused in consumer discretionary, which includes leisure and travel. It includes retailers. If you look at the Canadian market, really that's about the strongest sector of the market, even though it's a very small part of the Canadian market. U.S., obviously, it's much bigger, 17-18% of the S&P. So there's a bunch of sectors that benefit in this environment, and breadth slowly is expanding in equity markets in the developed countries, and so money is getting put to work, and it's coming from other asset classes like bonds and real estate and commodities.
Our viewers will know that you like to put stops under your positions. The move was pretty dramatic in August. Did you get stopped out of a few stocks?
It's interesting. The move in the S&P was a 7% drawdown. And we use stop losses to try and protect against reversals in direction. So if a stock is making higher highs and higher lows, a pullback is not a bad thing. It's a correction. And we came out of October well over 90% invested. So very few of our stops got hit. Mm-hmm. The biggest reduction from a sector exposure that we went through really started in July and into August was leaving the energy sector largely, other than infrastructure.
Right.
And that would have been the majority of the money moved away, and it moved towards things that were more either consumer-centric, healthcare-centric, transportation-centric, or technology-centric.
Now, the energy infrastructure stocks that you've talked about before and likely still hold, the Interpipes of the world, are they okay in this price environment, or is there a problem?
If you look at the value chain in energy, the most highly correlated to oil and gas would be the equipment companies, then the drillers, then the exploration and production companies, all highly dependent on price. Then you have the refiners that are partially dependent on price. And then you get into the infrastructure companies that have actually a very little correlation to the price. They're more volume dependent. Having said that, there's a halo around energy, and it does impact. And so we've taken down our infrastructure weighting by between a third and a half. And it's not because we don't think these things can continue to churn out great dividend growth. But the fact is, if energy prices remain weak, there's going to be a drag on the sector. And there are some other opportunities that we've been moving towards. We really like them. We just had to reduce our weighting given the fact that they're now relatively underperforming the market.
All right, David, we will take a break and then get to questions after that on North American Large Caps for David Burrows.